Did you know that when Lehman Brothers collapsed in 2008, it marked the largest bankruptcy in American history? In a matter of days, over $600 billion simply vanished, wiped out almost overnight. The shockwaves from this event didn't just rattle Wall Street, they reverberated around the globe, shaking the very foundations of the financial world. Let's rewind to a time when Wall Street seemed invincible. Lehman Brothers, with a legacy stretching back more than 150 years, was a pillar of American finance. It was a name synonymous with trust, stability, and resilience, a company that had weathered every storm the economy could throw at it. Through world wars, the Great Depression, and countless recessions, Lehman Brothers stood tall. Generations of employees built their careers here, believing the firm was unbreakable. But in 2008, all that history unraveled in a matter of months, faster than anyone could have imagined. So, how does a financial giant, trusted by millions, simply disappear? What went so catastrophically wrong? The story begins with the housing bubble. In the early 2000s, Lehman dove headfirst into the booming real estate market, pouring billions into risky mortgage-backed securities. They bet big, believing home prices would keep climbing forever. The profits were enormous, and for a while, it seemed like a winning strategy. But when the housing market crashed, those once profitable assets turned toxic. Suddenly, Lehman was left holding mountains of worthless investments. The losses piled up at a staggering pace, and the firm found itself trapped, unable to escape the consequences of its own risky bets. Inside Lehman's boardrooms, panic set in. Executives scrambled for solutions, but the options were running out. The sense of crisis grew with every passing day as the firm's leaders realized just how deep the trouble ran. Lehman's debts ballooned, and confidence in the company evaporated almost overnight. Investors and clients began to question whether the firm could survive, and the pressure mounted relentlessly. As fear spread, investors rushed to pull their money out. Other banks, sensing danger, refused to lend. The credit markets, the lifeblood of Wall Street, froze solid, leaving Lehman isolated and gasping for air. Earlier that year, the government had stepped in to rescue Bear Stearns, another major bank on the brink. But when Lehman Brothers pleaded for help, regulators drew a line. They decided to let Lehman fail, believing the financial system could withstand the shock. It was a gamble with consequences no one fully understood. The fallout was immediate and devastating. Stock markets around the world plunged. Banks stopped trusting each other, grinding the global financial system to a halt. Even businesses and families far removed from Wall Street felt the pain as credit dried up and uncertainty spread. Lehman's collapse destroyed thousands of jobs, wiped out billions in savings, and shattered the illusion that any firm was too big to fail. The shock was personal for many. Families lost homes, retirees saw their nest eggs vanish, and entire communities faced economic hardship. The aftermath changed banking forever. Suddenly, risk became a dirty word, and governments around the world scrambled to rewrite the rules, hoping to prevent another disaster. New regulations, stress tests, and oversight became the norm. Looking back, the fall of Lehman Brothers stands as a stark warning, a story about unchecked greed, the dangers of ignoring risk, and the high price of missing the warning signs. It's a lesson that still echoes through the halls of finance today. If you want more finance tales unraveled in under 3 minutes, don't forget to hit subscribe. There's always another story behind the headlines.